In fact, that interview was taken by my colleague Yash Jain, who's joining us now with a special guest to discuss this crucial development even further. Yash, over to you. Take it away.
Thanks, Ashmit. Joining me now to discuss this further is Nilesh Sathe, former member, life insurance at the Insurance Regulatory and Development Authority of India. And what we're discussing here are two different subjects. One is, of course, the proposal to increase FDI in the insurance space from 74% to 100%. And second one is equally crucial, the Insurance Amendment Bill. To start with the proposal on FDI, Mr. Sathe, since we are speaking about taking the FDI to 100% from the current 74% in a sensitive sector like insurance, I want to understand from you, in your sense and your reading, should this approval be given through automatic route or, through an approval case-by-case basis by the government? And the second question is that when this FDI limit was raised from 49 to 74%, not much happened in terms of action and interest from foreign guys. Now, when the proposal is expected to be raised to 100%, do you expect significant interest to come from foreign insurance players? And could this be in the form of fresh licenses or acquisition of stake in Indian insurers?
Yes, it will happen in both. Because the existing players are also keen on increasing their stake to 100%, one. Second is there are many life insurance companies and general insurance companies in the world which are much, much bigger, which have not entered the insurance area in the world, in India as of now. So they are also waiting for the 100% stake to enter. Just take example of Berkshire Hathaway, United Health, Ping insurers of China, and so on and so forth. There are many insurance companies which are much bigger. They are awaiting 100% FDI approval because you know what happened, if you remember, Yash, when it was made to 49, there was slight amendment where the Indian ownership and control was required. Now that is something which has created a problem. So the foreign insurance companies probably are of a view that if Indian ownership and control continues or is again restored, then they are not interested. Although it was removed when stake was increased to 74%, but still from 26 to 49 when it was done, this is something which came in the way of foreign insurance companies entering the insurance market.
And to your understanding, should this approval be given on an automatic basis or should it be a case-by-case approval mechanism which should be put in place?
No, it should be on automatic basis because even for 74% or 49%, it was on automatic basis. So why there should be a change? We should not keep changing our policies back and forth.
Correct. A word on the Insurance Amendment Bill also, and the most important aspect under that bill is Composite Insurance License, yes, which allows cross-entry of insurers. Do you think a very stringent process of approval should be put in place? Because, underwriting a life insurance policy is a lot more complicated than underwriting a health insurance policy, and hence a cross-entry should go through a stringent examination. And do you expect significant shift in terms of the players entering the other side of the business as well?
See, some of the players are too keen on entering, like LIC. LIC agents are marketing insurance products of other general insurance and health insurance companies. So if at all, and they have a strong agency base. So if at all they enter this market, obviously their agents will sell their own products instead of going somewhere else. And again, there are many insurance companies which are keen on marketing the products of other lines of business. So there is definitely a scope. And they have got everything in place. See, accounting is in place, risk, all criteria are in place. Outsourcing is in place. So what is required is only separate accounting of general insurance and life insurance business. Once that is done, and which is very easy to do nowadays, it's not difficult. So, and if you remember, before 1971, when the four general insurance companies were carved out, New India and others, LIC was doing this business. LIC was doing general insurance business. But that time, of course, the business was very, very small. What is important today is, because of IT, it is easy to keep accounts separate, and it is not difficult to manage these businesses by insurance companies.
So, of course, not difficult to manage the two businesses, and there could be a significant shift. One point under the insurance amendment bill is also reduction of the initial capital to start business. With that particular proposal and the approval there, do we run the risk of certain non-serious players also entering the insurance space, considering that the initial capital requirements could come down significantly?
See, nothing can be ruled out. But yes, you tell me one thing. Before nationalization of insurance companies into LIC, the regulator was not strong. The provisions were not in place. The investment norms were not in place. Now everything is in place. So it is very difficult to, bypass any of these rules and regulations. And let us give a chance. I'll give you an example. Dubai has got 68 insurance companies. What is the population of Dubai? And out of that, 60 are in profit. UK has got more than 400 insurance companies which are working. What is the population of UK? 1/7 of India. Why we cannot have, or we should not have, more insurance companies? And that is possible if line of business wise or region wise licenses are given and the capital requirement is reduced. Although it provides only 100 crores for life insurance and general insurance and 200 crores for reinsurance, you will find that all the insurance companies, without exception, have more than 1,000 crores of capital. Because to do more business, you need more capital. So to start with, there is no need to have such a huge amount of capital. If you are doing a business which has got a short tail, as we call it in technical term, means like motor business, where the claim is going to come in a year or two, or maybe in case of health, in a year or two. Why do you need so much of capital? If less capital is given, see, capital is always scarce, especially in developing countries, it is very, very scarce. So if at all option is given to start insurance companies, take example of all these distributors of cars. They can have their own insurance company and they will have their own client base. What is wrong in that?
Correct.
And controls can be established. Now regulator is very strict on this.
Correct. I mean, the regulator has also been saying that to cater to a population of 1.4 billion and counting, we need many more insurance companies of different sizes to enter. Right. And I think the capital requirement will be an important step in that direction. But of course, there are many more interesting points under the insurance amendment bill also. And all of those will be very keenly watched, potentially being tabled in the parliament session and having an approval and how things pan out for the sector post that. But thank you, Mr. Sate, for your time today. And with that, it's a wrap on this edition of News Center. More news and updates lined up as we come back from this short break.